What's going on, YouTube? In this video, we're talking about Chewy, ticker symbol CHWY. Year to date, this company is down 47%. Over the course of 1 year, down 50.5%. Chewy, what they do is they engage in pure play e-commerce business in the United States. The company provides pet food and treats, pet supplies, and pet medications and other pet health products for all sorts of different animals, any household animals, really. And they have 3,000 different partner brands also. So we're gonna look at their revenues and, well, not just their revenues, but their overall financials and take a look at and see how things are running or trending on this company. So we have revenue, gross profit, net income. Revenue, gross profit are growing. The net income you can see is growing. They bottomed and since have then started trending higher. So that's good. They're now positive net income. So that's good. Always good to see them grow into a positive net income. The gross margin is continuing to grow, looking like it might be slowing down a little bit. Yeah, it's definitely hit potentially a ceiling. Could grow a little bit more, but right now it's telling us that we're kind of peaked out at the moment. So the net margin here, same thing. We're kind of looks like we're kind of peaking out. We're sitting at about 0.5% here. It'd be nice if this company get like 2 to 3% net margin, since this is like a retail slash wholesale type business. So we have revenue, gross profit, year-over-year change. Again, this is just kind of adding to our point up here that we might be hitting a ceiling on this company where growth is beginning to shrink and right now we're sitting year over year at 20, and last year was 8% on the gross profit, 7% on revenue. So I mean, we're getting below a 10% grower. So we're sitting, and it's a consistent trend too, lower. So we might be sitting in that, 8, 10% growth rate range and maybe even a bit lower. But so that's going to make it very difficult for them to get their net margin just to, get it up a couple more percentage points there. So I think analysts are seeing that, which might be why this company is currently trading near or at all-time lows. Return on invested capital, we're going to look at that over here. We are sitting at about 2% previously. So since in the last basically year, we've started to turn positive on return on invested capital, but still nominal number. I mean, we're sitting at 2 to 4% range currently, so not a very good return on invested capital in my opinion. Cash to debt on this company. This is a retail business, so I fully expect more debt than cash. And so looking at these two charts here is not something worth our time. We want to see that on the balance sheet and figure out, what portion of their debt is what is owed to their partner brands that they're getting these products from. Net income to free cash flow. So we have a substantially larger amount of free cash flow than net income. And we're going to scroll up here. So we have our net income of 52 million, stock-based comp 209 million, and that gives us an operating cash flow. Obviously, there's a few more numbers within that, but we can very easily see that stock-based compensation is a big part of our operating cash flow. And then we take our operating cash flow minus our CapEx, gives us the 340 of free cash flow. So basically, we can, based off these few numbers there, pretty much tells us that stock-based compensation is the reason why we are free cash flow positive. So, we can see that over here. Our share count is getting diluted year over year more. They continuously issue more shares through stock-based compensation. So, as a shareholder, you don't really want to see that. I also am not a big fan of free cash flow positive, mostly because of stock-based compensation. No investor really wants to see that. So our free cash flow here is turning positive, but in my opinion, not for the right reasons. Our capital expenditures hopefully have also peaked with everything else and maybe start to trend a little bit lower. I mean, for CapEx on here, this is pretty good, sitting at like just shy of 200 million in CapEx. So not too bad there on the capital expenditure side of things. So really, the things we want to look through on their 10Q real quick, we want to know a little more about their cash to debt here, figure out exactly what number is suppliers that they owe their suppliers, and then also the free cash flow here, figuring out exactly where some of that money came from, which we probably already know. So on assets here, they have 900 million cash. This up here is left-hand side is 2023, the most recent. So this is 6 months. We have trade accounts payable. We can see is 1.1 billion. I'm sure they've got some sort of deal worked out with their customer, their suppliers, saying once product sells, we then pay you what you're owed. So basically, they're gonna claim that as a liability because they do owe that money to their suppliers. So that's 1.1 billion dollars that goes to the suppliers. So in terms of debt, we can take off 1.1 billion dollars in total liabilities, which puts them at 4-ish billion dollars in total liabilities. So 1.4 billion in total liabilities to 900 million in cash, kind of expected. I would say that is more normal. So nothing to be, in my opinion, too concerned there, as long as their cash continues to grow and their liabilities don't grow too much. Net income here, our SG&A on this company is it is a lot. We're sitting at like $1.6 billion in the last 6 months of SG&A. And this company doesn't have stores. It's all purely e-commerce. I'm sure it's got a warehouse, probably have several warehouses, I would imagine. That's something that's worth looking into more, is to see if they have several warehouses or what the case is. So it might be just a big warehouse that they have to have a bunch of people hired to move these products and ship them out and whatnot. So that could be a pretty good reason for the SG&A. But it might be worth digging into to know, is there a chance that they could trim off some of that SG&A and then grow their net income? That could be a potential possibility on this company. So after we deduct all that out, that gives us an income from operations of $6 million. Interest income and other income is putting them at a positive $43 million, minus taxes gives us a net income of $41 million. The only reason they are really income positive is from interest income. Really, their main core business generated $6 million of cash for them, of net income. And then they add in other interest and other income, whatever their other income might be. And then that gives them a positive, net income there. So a little bit more of I wouldn't say it's a concern, but it's something to keep an eye on for sure, as this company continues to grow. But we're also seeing that this company is not growing that fast anymore. So their net income is probably not going to grow much, isn't going to grow any quicker than their revenue and net income, or sorry, gross profit, until maybe they cut out some SG&A, and maybe that helps them grow their net income. So something that is possible, but again, I think that's worth looking into to understand more about how their SG&A works, if you can find it. So our net income comes down to our cash flow statement here. We're sitting at $41 million in net income. Depreciation and stock-based compensation, we can see is 170 mil right there, 170 mil. And that pretty much is majority of our cash from operating activities, at least 130 mil. But then you add in your net income, puts you at about 210. So there's about $90-ish million difference between the rest of what you got going on down here. And everything from here down is all just changes on assets and liabilities. So we can see a good chunk of this, though, is going to be stock-based compensation, and also a good chunk is depreciation. So not ideal. We want to see cash provided by operating activities much closer to our cash from operating activities. So then we take our 307 cash from operations minus our capital expenditures of 79 million, which they've done a good job of reducing their capital expenditures year over year. Reduce or take out our 79 million, leaves us with 228 million of free cash flow. And then we can subtract out our stock-based comp and gives them 114 million of true free cash flow. So they are still, if we take out our stock-based compensation based out of everything else that this company is doing, they are still a free cash flow company. So positive free cash flow company. Nothing too surprising. Everything kind of made sense. I think this company just is slowing down growth wise. So we have 4 comps. We have Wolf, Walmart, Target, and Bark. So we have 3 red flags on Chewy. We got return on invested capital, which we know is red. We have share change year over year, which is growing currently at 1%. We knew that. Operating cash flow is more than net income. We also went over that. So comparing all 4 companies together, these first few charts are not very good because we have Walmart and Target on the list. Our 5-year growth rate over here, They've got 144% EPS. Obviously, I don't really believe that. But we got 13% revenue growth. And so that kind of maybe tells you maybe this will pop back up into a low to mid-teens grower going forward instead of sitting at below 10% growth rate. So maybe they're right. Maybe in the next 5 years, this will be an average 13% growth rate. So we'll wait and see. Gross margin on the company, it'd be nice to see if this company could get it a little bit higher, but overall, it's not too bad for gross margin being a retail business like this. Operating margin, this is where it'd be nice to like get up to like that 3% range where some of the other retailers are at. They're at half a percent right now. So they're close, but I think it just because but they still just they got more work to do. If they can get that up to 2 or 3%, then this could be a pretty decent buying opportunity on this company. But right now, it looks like they're struggling to get to that point. Profit margin, this similar deal here. If we can get this up to like a 2-3% profit margin on this company, same deal. I think that this could be a good buying opportunity on this company. And cash flows as well. If we can see a better cash flow of actually from cash from operating activities, not cash flow just because we're diluting the shareholders. Return on invested capital, this is going to be one of those that we're probably not going to see much more than maybe 10% on. PE, tremendous PE on this company sitting at 156, everybody else 30 or less. So that kind of tells you how overpriced this company currently is sitting. Well, over here at the calculators, Peter Lynch valuation, $17.34 per share on Peter Lynch valuation here. And that is allowing a $144 EPS growth rate, which we're going to change in the future here. But we're going to leave this because it's still below our current trading price. Multiples comparison, we're going to eliminate Bark here because they have a negative PE. And our multiples gives us $2.81 per share. Manual PE on this company, market cap, minus cash plus debt gives us 18.4 years. So our PE, our manual PE, a different way of looking at PE. So we're sitting at about 18.4, which tells us it's undervalued. So that's good. Price to book. Well, we're not even going to look at that one. That's not even worth looking at. PEG ratio, kind of same deal. We already know the growth rate on this company is not very good. We're looking at price to earnings divided by growth here, and our growth compared to our current PE is ridiculous. So we have intrinsic value. I'm actually going to give this company a 2 here. This might be just one of those really slow. I wouldn't even call it a stable company. You know what? We're going to keep it at a 1. So Graham's valuation, $15.75 per share. Discounted cash flow. Analysts have a growth rate on the free cash flow of 43%. So I matched their 43%. They have a history of 254% growth rate. So if we go back and look here at our free cash flow growth, we can see we've started to turn into the positives, but we also know they're not for the right reasons either. Discounted cash flow then gives us a price per share of $36.18. Rule 72. Here's where we're going to change our EPS. Look at this, 144. Yahoo Finance 26. Seeking Alpha didn't even give us a future EPS growth rate. So if we were to use those numbers, that puts us at we're going to double our EPS 8 times in the next 10 years. That's going to put us at 31. Well, I'll tell you right now, I don't think that this company is ever going to see $881 per share. So that being said, what we're going to do is we're going to change this. We're going to put this at like 20%. Let's say it grows at 20%. So then we double our EPS 2 times. So that puts us at 0.48. And then that gives us a valuation of $3.68 per share. I believe that's probably more fair. It could be low, could be high. We do know, however, that our forward-looking PE on this company, or sorry, EPS is 58. So maybe what we do is we take and change this to, we'll put 40 in, and then we'll eliminate this 0. So then that'll give us a 4.5. So we'll call it 2. So maybe that's a better number. Let's use that number. I feel like that's probably a better expectation of this company for the next 10 years. We'll roll with that and see where that puts us for a final valuation. So we roll up here. We have all of our price tags that we've gotten from each one of our calculators that we went through. Gives us an average price of $20.87 per share. 30% margin is safety in this company. For acceptable buy price, you're looking at about $14.61. Analysts have a price target of $36.90. I think This is probably one of those times when analysts are priced in at a higher than where the company's trading, so they're going to put a higher price target on this company because they can do that, or I'm sure they do that. So that's why I don't always like to go off analyst price targets because they can manipulate their price targets. They can just tell you, hey, I think the price target's $40 per share, when in reality, they're just trying to get you to buy Chewy, and then that way they can get out of it real quick and not take so much of a loss, or get out of it for a little bit of a profit even, and then you take the loss on it. So they do that. They probably won't own on to it and tell you that, but there's a lot of I'm it I guarantee you it happens. So what we got is $20 per share. Currently trading 18.75. So basically it's trading at fair market value. Um, I still think this company is very overvalued, but we're going to take a look at the stock chart and see how it's trading technically. And we can see it IPO'd not that long ago in 2018, 2019 for about 35-ish dollars per share. Ran up to $120 per share. Holy cow. And since then has pulled back to all-time lows, sitting, at about $17.50 per share. And I gotta say, I think this thing is still overvalued based on where it's even trading now. So it's no surprise to me that analysts have a price target of 38 plus dollars on this company right now, just to try and maybe, you know, get out of it. Hopefully people buy it up to that price tag that they have on this, and then they can get out and move on to the next stock that is probably not going to be profitable for them either. So that's kind of what we're looking at on Chewy here. There's not really any lines to draw on this company. We're trading at new lows. There's no current support to draw. You don't really know where the bottom's at. Obviously, this thing is incredibly oversold and is probably inevitably going to bounce up to like at least to this trend line. Retest this trend line maybe at 26 to $27 per share. And my guess is it might continue to roll over. I don't know that unless earnings turn around on this company big time, which it doesn't look like that's going to happen. I think that's kind of what's in the future for Chewy here. I think this thing has a bounce in it, and then probably a roll back over, and then probably just kind of chop around, and maybe one day it'll start heading higher. But I think this is a company we're staying away from. Honestly, in my opinion, do what you want, but based on what I'm seeing, this isn't a very exciting company to want to jump into. Growth really isn't there anymore. It is a fantastic business model, I think, but I use this company. I have them deliver pet food and stuff to my house, and it's super easy for me. And it's a subscription-based model. It works very well, but maybe there's more growth to be had. I don't know. But right now, this doesn't look too exciting to me, and that's what I got for Chewy on this analysis here. So, but if you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.